Vuelta en Rolling Stocks. Durante los próximos minutos vamos a poner el foco en la inversión y lo vamos a hacer además con un análisis internacional de la mano de Teresa Keane. Teresa Keane es Product Director at AllianceBernstein. Teresa, good afternoon, how are you?
Good afternoon, I'm very well, thank you very much, and thank you very much for having me here today.
It's a pleasure to us. You got 10 years of investing in defensive equities. Tell us, please, how that came about and what client need to see you to addressing.
Yes, indeed. We have over 10 years of investing in low volatility equities, defensive equity investing. It really came about as a result of the global financial crisis. We felt that beating the benchmark was simply not enough. The pattern of returns was just as important for our clients. That investment journey, that upside capture in rising markets, as well as mitigating losses during down markets. And if you look at the chart, you can see that actually that's what we aim to do. We aim to outperform the market over the long term. But during market crises like what we're in now, we're aiming to mitigate these losses. And it's that investment journey that's actually enabling investors to stay invested over the long term. So in terms of the client need, actually over the last 10 years, the client need hasn't really changed because clients still need that long-term return and capital growth. But clearly in a market like today, they're very wary of this macroeconomic environment. We're all living longer. We need our capital to go the distance. And then, of course, investors aren't always necessarily compensated for that higher risk.
In fact, in 2022 was a dramatic year for markets. Even if we think that in 2023 we are better, we need to see at the end of the year. But in 2022 was a dramatic year for markets. This is a fact, and the global economy as a whole. What are some of the key desestabilizing forces that are increasing the arsenal now?
Yeah, 2022 was very traumatic. It was very traumatic for every investor. I mean, the key risks, and they still are out there: high inflation, rising rates, geopolitical risk, slowing growth. These still dominate the market even today, but they certainly did so last year. And the Fed acknowledged, there is no easy way to rein in that inflation, and hence why we saw the aggressive rate hikes that we did over the past year. At the sector level, in fact, all sectors declined last year. Energy was the only one that outperformed, rising, benefiting really as a result of the higher oil and the gas prices. But when the investment team actually look over that period and the past 10 years, the investors have operated really with three long-held beliefs, and that is that inflation was dead, or at least transitory, that the Fed would always come to the rescue, and that tech would grow forever. But actually 2022 really broke that cycle, because what we're seeing today is that inflation is certainly not dead. The Fed isn't always going to come to the rescue, and 2022 is certainly an example of that. And unfortunately, we've also seen that tech may not grow forever. And we've seen that in the last quarter last year and also again at the beginning of this year. So a very traumatic time for investors overall.
Without a doubt. So how can investors identify the stocks with the potential to mitigate this downside risk as you speak now?
Well, we believe ultimately there are three pillars that are required for mitigating losses and mitigating risk in an environment like this. When the team were designing this platform and the strategy, they spent a year looking at the various anomalies. How can we deliver on that upside capture as well as mitigate losses during downturns? So they came to the conclusion that quality, stability, and price are very crucial. And that's what's helping us today to mitigate these losses. So we're countering inflation with quality. We like companies with solid pricing power and with strong return on invested capital. We're countering stable, we're countering that earnings risk with stability, and of course price is always going to be important. We're investing in companies today that are less susceptible to rising interest rates. So that's really our key, the core positioning of what we're trying to do today and over the past 10 years, I should add.
How are you achieving that resilient positioning today versus your peers?
Well, versus peers, we're very much an active defensive strategy. We're an active core strategy, global equity. We're quite different versus peers in the sense that not only are we finding opportunities today in the more defensive sectors of the market, like consumer staples, like healthcare, like communication services, but we're also finding unexpected sources of stability in other sectors. We're finding opportunities, for example, even within technology, financials and energy. Within technology, for example, we like the tech enablers of the world. You know, when you go to a restaurant and you need your QR code, it's those types of tech enablers that we like to invest in. We're looking for businesses that are very defensive, recurring revenue. So really for us, a defensive equity strategy has to be grounded in company fundamentals that exhibit these characteristics of quality, stability and price overall. Intangible assets are also important. And what I mean by that is where a company actually stands relative to its peer group. Does it have a brand? How competitive is it? How niche is it? And so on. So these are some of the other attributes that our fundamental and quantitative research analysts are always taking into account.
Yeah, so interesting about your opinion. Your opinion about that theme. Can you give us more background on the fund and what are some of the key lessons that the team have learned from 10 years of portfolio?
Okay, well, some of the, a bit of background on the fund. The fund has been managed over the past 10 years by Kent Hargis and Sami Suzuki. It's 5 billion in size at the moment. It is also, in terms of lessons learned, I think one of the key things that they will tell us is that every downturn is different and each one is just as stressful. You can't time the market, that's for sure. How do you get in and out of these different periods? It's not possible to predict what's going to happen with the macroeconomic environment. So this is a way to stay invested in the market as a whole. We also believe that diversification is important. Diversification, as I said, in finding stability across unusual sectors like the technology, like the financials of the world, but also in more defensive areas of the market. And risk is dynamic. It's ongoing. It's always out there. And hence why this is a way to deliver on that 90% upside and 70% downside over the long run.
Allow me and the last question, please. How should investors use this strategy within a broad asset allocation framework?
Well, within a broad asset allocation framework, this is an excellent complement to higher risk equity strategies, beta 1 strategies. This is a low beta strategy. It's got a beta of 0.8 to 0.85. So it's a good complement and it sets out to reduce risk overall, improve the Sharpe ratio. It's also a good complement to other asset classes, should I say, such as bonds. So it's got a lower correlation. So in an environment like last year where equities and bonds were positively correlated, a lower beta equity strategy actually did provide that lower correlation to bonds.
Teresa Keane, yeah, tell me.
Sorry, I was just going to say, so the team overall are delighted to mark this 10-year anniversary, having outperformed the market as a whole, and actually are in the first percentile since inception in terms of Sharpe ratio.
Congratulations for these 10 years and enjoy another 10 more unless. Teresa Keane, Product Director at AllianceBernstein. it's a pleasure to us. It's been a pleasure to us have you in the program, and have a nice week and a good job.
Thank you very much. Really appreciate it. Bye bye.